Thank you, Mr. Damani, for joining us. It's a pleasure to have you with us today. Our second panelist, ladies and gentlemen, please join me in welcoming on stage Mr. Madhusudan Kela, the Chief Investment Strategist of Reliance Capital Limited. He's one of the founding members of Reliance Capital and was instrumental in setting up the mutual funds business. He was also the recipient of the 2004 Business Standard Equity Fund Manager of the Year. Under his leadership, Reliance's assets under management have now grown to a staggering rupees 2 lakh crore. Thank you, Mr. Kela, for joining us. Our next panelist, please join me in welcoming on stage Mr. Prashant Jain. Mr. Prashant Jain is the Executive Director and Chief Investment Officer at HDFC Mutual Fund, with assets of nearly $30 billion US, of which $12 billion US is in equities. Mr. Jain has over 25 years of investment management experience. He has the distinction of having managed a fund continuously for over 23 years with a CAGR of approximately 20%. Mr. Jain, pleasure to have you with us, sir. Thank you so much. Our next panelist, ladies and gentlemen, we are delighted to have with us Mr. Vetri Subramaniam. May I please request him to take his seat on the dais? Mr. Subramaniam joined UTI AMC Limited as Group President and Head Equity. He has over 2 decades of work experience in fund management and research. Thank you to all the panelists for joining us. Ladies and gentlemen, to kickstart this evening, I'm going to invite on stage Mr. C. Parthasarthi, Chairman of the Karvy Group. Under his stewardship, the group has created immense wealth for investors. Please join me in welcoming him on stage as I request him to deliver the welcome address.
Good evening, ladies and gentlemen. On behalf of all of us at Karvy, let me take this opportunity to welcome you to this event. The response has been stupendous. I apologize for people on the sidelines. I'm told that this has a capacity of 800 people, and we are really overwhelmed by this response. The next time we hold something like this, we'll hold it in a stadium. Having started as a magazine and a website, the Finapolis has now created a knowledge series for which we intend to approach the investing public through meetings and conferences of how to invest, where to invest, and gradually attain self-sufficiency in seeking an appropriate advice for creation of wealth for themselves. Karvy, as you're aware, is an organization that has a people strength of over 27,000. We are primarily into financial services and have reasonable prominence in the areas that we are involved in. In 1979, when the Sensex was introduced, it was 100, and today it is over 30,000. It's a clear indication of the fact that enormous wealth has been generated and a lot of individuals have benefited. The overall market capitalization of the Indian markets is 125 trillion rupees, which is 125 crores. That is the size and the magnitude. Even today, the daily volumes on the exchanges are about 500,000 crores, and that clearly gives you an indication of the strength, the liquidity, and the depth of this market. The Indian economy has been growing at a rapid pace and is now acknowledged as the largest growing economy in the world. While the eminent panelists will tell you a lot about the economy and the markets and how they will behave in the next few years, it would suffice to say that we are probably in the cusp of a golden period. I'm sure that we've got all our acts right, and I have no doubt in my mind that the next 5 or 10 years will be golden years as far as the Indian markets are concerned. I want to express my sincere gratitude to all the panelists for having taken time from the busy schedule and for having come over for this event from Mumbai. I'm grateful to Lata Venkatesh, Prashant Jain, Madhu Kela, Vetri Subramaniam, and Mr. Ramesh Dhavani for having been kind enough for accepting our invitation and being present here today. Let me now hand over the proceedings to Lata. Thank you.
Is this better? Okay. Yeah. Can you please check your mic? Vetri?
Yeah, test. Yeah.
Fine. Mr. Daman?
40,000, 50,000.
Wow. Some test. Mr. Kellara, what will you say?
Lata.
Prashant?
Good evening.
Okay. We have to wait for our television audiences. They are a multiple of this stadium that Mr. CP has put up for us here. Can we? Narayana? I'm starting. You're just cutting out of a show and starting this, so you'll have to bear with me for just a few seconds before. It's commercial break time, so we have to wait. Well, I could tell you in the meantime that the guests, the panel I have with me here are between them over 100 years of stock market experience.
And I was there through the 100 years.
Sorry?
I'm so old, I was there for 100 years.
Welcome to the Market Masters. Is this the mother of all bull runs? Why are we asking this question today? Basically, we have looked at several parameters which are pointing to whether India is in a new normal. Is India in a new normal? First, inflation. Low and stable inflation. For the first time in our economic history, we have a central bank which has been given a target of 4% inflation plus or minus 2%. So it is committed to keeping inflation low. The second new normal for India is the rupee. As long as inflation is kept under check, if the rupee buys more potatoes, if the rupee buys more bread, it will buy more dollars. An inflation targeting central bank generally does not like a depreciating currency. So we could have a strong currency which would be a bit of a paradigm shift from the kind of situation that we have seen so far of a slowly depreciating currency. A third new normal, low fiscal deficit. When the government signs with the central bank an agreement that we will force you to keep inflation at 4%, it thereby gives a commitment that I will also not ask you to print too many notes, which means I will not have high fiscal deficit. So are we entering a period of sustained low fiscal deficit? Now what happens in a period of stable rupee, stable to rising rupee, low stable inflation and low stable fiscal deficit? Financial assets become more attractive than physical assets. Because the rupee is likely to buy more and certainly not buy less, the traditional Indian desire to invest in gold and land, which are seen as hedges against inflation, no longer become attractive. So, are we going to see the fourth new normal of a wall of money invested historically in gold and land coming into financial assets? And therefore the question, are we on the throes of the mother of all bull runs? That question to you, Mr. Ramesh Daman.
Lata, first, thank you, and thank you, Karvy, for having me out here. It's a great privilege for all of us to come from Bombay and speak to this distinguished audience. Lata, bull markets attract two kinds of people, if I may tell you. There are people with money and there are people with experience. And by the time the bull market gets over, people with money end up getting the experience, and people with experience end up getting the money. Okay. I want to speak to you with the voice of experience. Typically, we all tend to think the bull market, that the earth is the center. Okay. Hello? Hello?
Seems to be okay. Maybe you want to raise your voice.
Hello? Hello? Is this better?
Yeah.
Sorry. All right. What I told Lata, so that I can repeat myself, bull markets attract two kinds of people. People with money and people with experience. And what happens when the bull market peters out is that the people with money get the experience and the people with experience get the money. So I'd like to speak to you. I'd like to speak to you in the voice of experience. We all tend to think that the earth is the center of the universe, and we think that every bull market that we undergo is probably the biggest bull market, the mother of all bull markets. But in my experience of reading history and reading economics, each bull market tends to be bigger than the previous bull market. There are more money-making opportunities. There are more multiplication of businesses. There's a deeper universe of stocks available out there. So while the 92 bull market, which is the one I first experienced, was phenomenal, it took ACC to some crazy valuations. You see now ACC is significantly higher than those valuations, and there are whole new leadership, whole new industries that didn't exist in 92. So to answer your question, Lata, I think this is a bull market, there's no doubt about that. It's a very big bull market, bigger than the previous one, but I'm sure in the India of 2025, India of 2040, there'll be bigger bull markets than we're having now.
But you agree that this could be bigger than the ones we have seen?
Almost certainly. I think there's no doubt about it. It's already showing those signs. Look at the early leadership, what Eicher Motors has done, what MRF has done. Enormous amount of wealth has been generated. The good news, Lata, if you want, is that we are well within the bull market here. There's no signs, despite an overflow crowd to hear us speak today. I think the bull market is still well and truly intact.
Eicher Motors and MRF, one of the conditions here that the more the stocks, the more the claps. People are hanging on to every word that you say. But Vetri, I know you all have your constraints with respect to referring to stock, but if you can illustrate with historical examples. For the moment, my question is more academic. Am I right in saying that we are in a new normal? Do you think that we have not before seen this kind of a chemistry of low inflation, probably rising rupee, low commitment of fiscal deficit being low, and therefore perhaps the best macros, and therefore the best attraction of money to financial assets?
Yeah, I think you've put all the elements together quite well over there, Lata. Let me just give you another analogy. If I go into the kitchen at my house, it's pretty well stocked. It's got everything that you could use to make a great meal. Whether it's the ingredients, whether it's the implements, everything is there. But if I go in, the results are less than something that you would like to make a meal out of.
Okay.
But my wife goes in and it's magic, right? So if your question is, do we have all the ingredients to put together something that could be much bigger, and as Ramesh rightly said, every story is bigger than the previous one, then yes, certainly all those ingredients are in place. But I think for it to come good, every stakeholder in this economy will have to do his bit, whether it is investors, putting money into financial assets, whether it's the magic of the entrepreneurs that Ramesh talked about, doing their bit in terms of creating value, and eventually even government either doing its bit in terms of enabling more business or at least staying out of the way. So I think we've got all the ingredients, but we'll just have to wait and see how tasty the dish really is.
Okay. I'm keeping the government bit out. We will discuss the growth prospects of having a stable government over many states. 53% of India now is under the same government which is ruling in the center, and with 2/3 majority in several states. But we will come to that in a bit. Prashant, actually I wanted to ask you whether any other financial asset is worth investing in at this point in time. In situations of low deficit and low inflation, FDs are fetching you 6% with tax. Without tax, they'll fetch you a little less. So, is there a push factor now which will keep the wall of liquidity coming?
So I think, yes, we are in an environment where equities are doing well and we are seeing reasonable flows, but let me put this in context. What the funds are getting is about $2 billion a month. It's about $25 billion a year. It's 1% of India's GDP. It is 4% of household savings. So while these numbers are large, but they are not large compared to the pool of savings in this country. As far as mix between fixed income and equities is concerned, I think return should not be the only guiding criteria. So fixed income, the role is it gives you safety of capital, and I think to the extent that you can spare money for 3-5 years, tolerate volatility, your risk capital, you should invest in equities. But I don't think I would like to make a case that you should move money lock, stock and barrel from fixed income into this. If interest rates are low, so is inflation. And fixed income cannot create increase in purchasing power. Its job is primarily to protect wealth. And I think that is a role which we cannot and should not ignore.
Okay. No, that point is taken certainly, and it will also perhaps depend upon one's age in terms of the ability to take risk and the necessity to take risk. But Madhu, let me make one confession. I got this idea from you. At the start of this bull market, probably a couple of years ago, it was you who said that no longer will it be attractive to keep money in land, and you will see people frustrated with their money in land not earning enough returns, and therefore forcibly a gush will come towards equities. Therefore my repeat question, that is there any other attractive class at all to put your savings?
First of all, thank you very much for acknowledging it. At least we get something for being bullish for last 10 years consistently on every fall. I think Lata, the conditions are such, specifically after demonetization. When you talk about new normal, one of the biggest new normal in India is transparency and cleanliness. That the drive which we are seeing under the current government and the cash economy which was in existence for many decades. Clearly there is a lot of scare in whichever part of the world you go. People want to pay more taxes and people want to move. So that effectively means that more and more money will move from physical to financial saving. And a 1% shift from physical to financial saving over the next 5 years would mean $150 billion more will come into the financial saving world. Second, is the question of also ownership. It is not that what is attractive or what is not attractive, because equities have been so underinvested over the years because of one scare or the other by the Indians, and it is the only asset class which offers you transparency and liquidity. So we are catching up basically because we did not invest practically anything between 2009 and 2013-14. So we are catching up in demonetization, transparency, no returns in every other asset class. Is only adding fuel to the fire. Is it the end? Are we in the mother of bull market? I have said, I must repeat at the cost of repetition. We are clearly, if that is not true, then I should be going back to my village, not being here. Because if the bull market is not ahead, what am I doing here? So what I am saying is that when we believe that we are going to go to a $6 trillion economy over the next 10 years, optimists will say that we will reach there in 8 years, pessimists will say that we will reach there in 12 years. So if the size of the economy has to go from $2 trillion to $6 trillion, which means $4 trillion of incremental wealth will need to be created. So there is still a long time before we will say that this bull market has ended.
Well, I made you all talk these numbers about, percentage of assets in financial markets being as low as, 4% of household savings, and that even a 1% shift will mean $150 billion. There was a reason why I wanted you all to say those numbers, and I'm glad you all said it. Are earnings worthy of it, Vitri? That will be the big problem. The big question which everybody every day asks us on television, off TV is that are we entering at the wrong time? So, we will see this wall of money coming, but are you worried that you are now no longer buying cheap, and maybe are you buying frothy?
So again, and just to build on something which I think Madhu alluded to and even Prashant did, the fact remains that Indians don't own enough equity. And if you look at it from the point of view of the kind of returns that they would need to get to their life goals and whatever their financial targets are, they will require to invest in an asset class like equity because it provides much higher returns than the other assets. So I think the reason they should be allocating money to equity, given their underinvestment, is really just from the point of view of correcting their underlying asset allocation imbalance. B, look, as far as valuations are concerned, the reality is that it's going to fluctuate. At times it's going to be pricey, at times it's going to be cheap. The challenge for most investors here has actually got to do with their DNA. It's easier to come to the stock market and get a room full like this when the market is closer to a new high than to get people flocking in when it's at a low. That's the reality. So I think, what I would really encourage investors to do, and I think the whole industry has been doing this, is to really tell people to say, invest gradually if you so choose, do it consistently over time, and over time, don't worry about the ups and downs of valuations. You will get to your financial destination in good time. So that's what I would really say as far as why people should invest. On earnings itself, honestly, it's been a case of earnings going missing. We've had 5 years of almost single-digit earnings growth at 3 to 5%. But again, when you go back to the kitchen example and the ingredients, a lot of reasons to believe that we have the ability for earnings to bounce back quite strongly in the near, over the next few years. But exactly when that spark will get ignited is something which is unknown. So I think that is an uncertainty that investors will have to deal with. There is no way out of that. And to believe that it is a complete certainty and base your investments purely on that, I think would actually be to take more risk than, is actually desirable. So be patient and just keep at it steadily, and the swings of volatility and valuations is something that you should be able to live with.
There's an ocean of investors here believe that Ramesh Damani, Vetri, Prashant and Madhu know whether growth is around the corner or not, and they want that answer. Mr. Damani, what's your sense? Do you think you can see at least the green shoots of growth? We have, dragged along with low single-digit earnings growth for quite a bit now, what, 4 or 5 years?
Lata, I'd just like to make a more nuanced point. I think, is the voice okay? A more nuanced point. When you look at only earnings as a unidimensional thing, and a lot of fund managers have no alternative.
No, once again.
Hello, sorry. I want to make a more nuanced point to you that when you look at only earnings, I'm a more bottom-up stock picker, so I'm not looking at aggregate earnings. You tend to miss the forest for the trees. What India is offering, the opportunity that we're offering, you could have bought in 2003, as you well know, all the liquor companies for 200 crores. That's the opportunity. It didn't matter. The earnings would come ultimately. We knew that. It was so cheap. This bull market, 3 years ago, you could have bought the entire logistics business for 500 crores. You could buy the entire media business for a few thousand crores. The opportunity in India, which is now Mr. Modi is unlocking, is you're moving from unorganized to organized. And entire industries are being built from scratch up. So you look at where airlines are today and where they can be 10 years from now. So you get confused by 3% earnings growth or 5% earnings growth. You'll miss the forest for the trees. The opportunity is extraordinary in this country. There are my wiser friends, whom I've learned from with many times, told me the two things that drove them through the 30 years of lots of upheaval in India. Markets went down, up, we had Kargil, we had plagues, we had communist governments come to power. The underlying thesis always was, be bullish on India. Because this country is offering this extraordinary opportunity with demographics, democracy coming together. And now we have a strong government in power at the central government, moving us from unorganized to organized. So industry after industry, vertical after vertical, will see the promised land. Don't get confused by earnings. They could be 1 year away, year and a half away. But just look at the market caps and the opportunity size available in this country. I think that's where the rich pickings are.
So that point is taken, but investors here would have been impressed by this argument in March of 2015. And, the index was at 9,000 at that time. Briefly, maybe for a few seconds, we got to wear some T-shirts at that time saying Sensex 30,000. We didn't get to use those T-shirts now for 25 months. So the fear of always investing in a crest is there. Are you getting that sense now that are we buying too expensive?
Absolutely not. I'm very emphatic about that. Lata, when a bull market's in progress, you want to be invested. If you miss at 7,000 Nifty, you're going to regret it. 8,000, you aren't going to get the exact bottom. There are always bull market signs that when a bull market is topping out, there'll be euphoria, a lot of debt on the companies, a lot of public, talking absolutely bullish things, bad quality companies going up very easily, lots of rights issue, lots of signs. The Panwala giving you tips, that's the best example you know of. A lot of signs will come out there. Right now, we're seeing good quality IPOs hitting the market, not very large amount of leverage position. Some froth in the mid-cap, that'll correct. I mean, so what? I mean, that will correct 20%. That's fine. So I don't see, more importantly than the earnings or the next, what's going to happen next quarter, investors should pay attention to when they think the bull market is topping out. Because once it tops out, let me be very clear about that, Lata, and for your audience, that all bull markets end badly. There hasn't been a bull market in any asset class at any time in the world that has ended well. This will too end badly. But that's like saying, because we all live and we're going to die, that we shouldn't live. I mean, there's lots of money, lots of opportunities to be made in a bull market, and then train and use some thought process when you think that bull market is coming to an end. That time move some financial assets to cash. But as far as I'm concerned, to answer specifically your question, while I do see corrections, say, in the frothy stocks that are going on right now, I would invest today, and I think the bull market is showing no signs of wearing out.
Okay, that's extremely comforting.
As clear as I can be.
Coming from a person like you, it's definitely. But Madhu, one can perhaps sense frothiness in some of the mid-cap stocks. Maybe you can sense it all the time. But even some of the very good stocks, I would assume, Marico trading at 41 times, 42 times, and that would be not the only FMCG stock.
Opportunity. You got to look at the opportunity. We can't just look at the earnings and make our analysis. We have to look what these businesses will be 10 years from now. You can't look the Indian real estate sector a few years back. You could buy it for the size of a pharma company. But 10 years ago, you could have bought the entire pharma company for one of the real estate companies. So you have to do that risk-reward analysis. And that opportunity size, this country has 125 crore people. All right, moving from unorganized to organized, looking for value. It's just one of those extraordinary opportunities. And by just focusing on a quarterly earnings, if you're an individual investor, you don't need to do it. I'm one of them, so I don't really care that much. I'm owning a piece of the business in the true sense of what Buffett is saying. So I'm happy to be a part of that business for the next 5, 10 years here also.
Okay, well, fair enough. But just to get the growth argument a little forward, no, I'm asking you because we are fresh from some very important news that's come from Delhi and that has moved now into Mint Street. The Reserve Bank, the government asking the Reserve Bank, urging the Reserve Bank now to tackle this default loan problem or bad loan problem in an extremely proactive manner. Now, like it or not, 30% of Sensex or Nifty, as the case may be, are banks. And they have been stymied by the bad loan problem. Prashant, you've watched these, over a long period of time through several cycles. Are you getting a sense that this big block of corporate lenders, ICICI, Axis, SBI, PNB, I don't want to call them public and private, but corporate lenders, could be the bargains that pharma companies were 5 years ago and real estate companies are now?
So I do sense it that way, that we are close to resolution in that space. And as SBI chairman said a few days back, that this loan problem should get resolved within a maximum period of 2 to 3 years. I think substantially it should get resolved much shorter. The good thing is that in India, most of the bad loans are secured in nature and the underlying assets have appreciated in value. So it's just that they are not able to service the entire loan, but with some restructuring, a meaningful part of that can be serviced, and whenever that restructuring takes place, both the gross NPAs and the provisioning levels will fall substantially. And in some of these corporate banks, both in public and in private sector, these are some of the best retail franchise in the country. They own subsidiaries in life, non-life, asset management, broking, few others, which themselves are very valuable. So I think if you put it all together, there is good value in that space in my opinion.
Madhu, you would agree?
Yeah, we've agreed for a while. What I'm saying is, Lata, my experience of 25 years is, whenever the problem is discussed so much, as this problem is being discussed, you have always found solution of that problem in India. That, you know, the crisis is the solution.
By that logic, media will find solutions to all problems.
Yeah, and but it's been persistently being discussed. You know, there have been committees, so I don't see that it will get resolved in the next 1 month or next 1 quarter. But there will be a resolution because now it is being raised to PMO, RBI, so many people have got involved. And as Prashant very rightly said, it's not unsecured loans which you are talking about. They are secured. There are some assets and they have been, a lot of these NPLs have been discussed over the last 3 years, 5 years. In the meantime, assets, the value of those assets have appreciated. And if you look at the public sector bank as a whole asset class, if I look at from 2008 till 2017, actually there is no money being made in most of these banks. In 2008, the prices of most of these banks were much, much higher than what they are. So whenever there is so much noise being made, we have to look to buy them rather than being worried about the noise. So that's the first point. The second point is that, you know, because there is the value is also there in their subsidiaries, and there are new ways which are there, like you can sell today to an ARC, that the ARCs are becoming bigger. So I feel there will be selective values. It's not like every bank which is public sector bank is a buy, but there are selective values which are available which should offer good returns.
Well, let me take a break from these macro questions and make you all a little uncomfortable. We have to talk stocks.
Sure.
And let me go to the one man who will perhaps do it with less qualms because he's not managing a fund, but managing private wealth. Ramesh, tell us something about your experience with, say, the liquor stocks, where you have made a lot of money, but you've always said you could have made more. How do investors approach a stock like United Breweries, which is in big trouble now?
I'll talk to that, Lata, but I think the point that you make is a very important point. And I tell you, what liberates you is an intellectual thought process. And I want to share that, particularly with the younger crowd is out there. Because once you understand that, I think everything will fall in place. And that is the principle of compounding. People think, how am I going to do this? How will I figure out the stocks? It's a priesthood. You know, you guys are in Bombay. You have all the inside information. Let me first tell you how compounding works, just for a second. You can be, 20 years old, starting with 10 lakh rupees. Okay, I'm not saying you start with more, 10 lakh rupees. And you compound that. Every 3 years you double it, or every 4 years you double it. At the end of the 30-year period, you'll end up phenomenally rich. If you compound it every 3 years, that 10 lakhs will become, 100 crores or something. 1 crore will become 1,000 crores. That's what happens over a 30-year period, thanks to compounding. So you say, how do I find a business that will double every 3 years or 4 years? Remember, the Indian economy is going to grow at 8 to 9%. Inflation has another 5%. So that's 15%. Dividends would add another 2-3%, 18%. We're just got to find a few extra percentage points of outperforming businesses. And you do that, you try and find businesses that are stable, have a long-term view. So unless we really go into some version of Ram Rajya that I'm not familiar with, I think we're not going to ban alcohol completely in India. I mean, we may, it's a risk. But it is...
But you leave for a short period.
I mean, it doesn't work time and again. The revenue required for the state, the deaths due to, banned alcohol being used, spurious alcohol is enormous. It doesn't make any sense in a free and open society to, to move to that extreme. So I think we are probably at the crescent of fear in these stocks. But the trick is to find a stable business. What will do well over the next 10 years? Media going to do well, entertainment going to do well, housing going to do well. Just figure out, buy a great business. And if it doubles for you every 3 years or even every 4 years, you're going to be very rich at the end of the process. So I'm not particularly saying a sector, but say, for example, the one that I'm bullish on currently, quick service restaurants. We're going to eat out. We want places to eat out. Vetri's wife might cook up a magic. I don't know about my wife, I eat out. So, people will want to eat out. That will be a long-term trend that will play out in this country as we become more demographic, as people work in urban areas. Women go out to work in the workplace. Labor is hard to find. You want to go place Wi-Fi, AC. So, those are good mix to find those kind of businesses. You saw what happened to a couple of retailing stories last year. So there are plenty of attractive businesses around.
Well,
just to
yeah.
maybe throw a question at you, but since you talked about that, liquor example, and I thought it might be useful to the crowd, were the returns front-ended or back-ended, and how long did you have to be patient? Because unfortunately, I think that's what gets missed out in some of this when people hear this.
I mean, I did have to wait, to be honest with you, but here was a value proposition I saw in 2003. You could get 50% of India's liquor market for 200 crores, right? Which means I could buy the entire business, 50% of India's liquor market, not anything else, 200 crores. That was the market cap. I would have crossed the Atlantic full of sharks, as Buffett said, to buy that business. And here, the market is offering you this opportunity, and people weren't willing to take it. For whatever reason, they didn't like Malia, they didn't like corporate governance, some of them well-placed. But 200 crores for 50% of liquor business is that. The point is not that. Madhu has found enormous amount of businesses. Prashant finds enormous amount of businesses that are that cheap, because that's the opportunity in India. I mean, is this the mother of all bull markets? Well, it can be if you take advantage of all these opportunities that are. So there are plethora of opportunities like this as India moves from the third world country to the third largest economy, from unorganized to organized, from charging high rents and tariffs to value seeking. So I think that opportunity will be there.
Lata, can I simplify this a little bit more and just add? Most of the time, a lot of you all are getting worried कि बाजार किधर जा रहा है, 30,000 है, 40,000 होगा कि नहीं, 50,000 होगा कि नहीं, और अगर कब घटेगा तो लेने का बहुत बढ़ गया है, अभी जब घटेगा तो लेंगे करके. Actually, what Ramesh is saying and what we have been consistently saying is those are wrong questions to ask. किसको क्या मालूम है, मेरे को एक दिन के लिए पता चल जाए exactly बाजार कहाँ जाने वाला है. 7 generations of mine need not work. Because it is trading 5 lakh crore rupees, I can make maybe 5,000 crore rupees if I exactly knew where the market is going in one day. So ये किसी को मालूम नहीं है. We are all debating theoretically, ये ऊपर जा सकता है, कभी ट्रम्प है, कभी कुछ है, कभी कुछ है. All we are saying is that India is a land of extraordinary opportunities. If you can do bottom-up stock picking, if you can find good businesses, you need not worry about where the market is going. You will always make money in good businesses over a period of time. The question is, everyone wants to make money in a hurry. You want to make money in 3 months, you want to make money in 6 months. ये कैसे हो सकता है? Like supposing, let's say, if a company is compounding its profit by 15%, by default, a stock cannot compound more than 15% over a period of time. Otherwise, you are more smarter than the businessman himself. How is that possible? That a business is compounding at 15% and the stock markets can compound at 20, 25, 30%. That's not possible. So, in whichever part of wherever the markets are, if we are able to find opportunities which offer that value, the only thing, my friend, is that you have to have that patience, because nothing comes easy in life. So if you want to make money in 3-6 months, then you have to be all the time worried about the market. But if you can take a 3-year, 5-year, 7-year, 10-year view, then that becomes very simple. So please ask the right question. कब लेना, not कब लेना है, कितना लेना है और कितने समय के लिए लेना है. So if you have those answers, that if I invested 2% of my fund in the best performing stock or best performing fund, but if I allocated only 2% of my wealth, even if it doubled or tripled, your portfolio is still not performed. But if you invested 30-40% in equity over this time frame, and even if you made 20% compound return, your overall portfolio has done exceedingly well. So even at this juncture, if you ask that can I invest 30% for next 5-7 years of the portfolio, the answer without unequivocally is yes. But the problem is that, as you rightly said, markets are where they are. If there is an external event which happens, let's say if there is something which North Korea does Ramesh know, does Prashant know, does Lata know, do I know what North Korean president is going to do, whether he will do the war or not? We don't know. But if that happens, market may fall 10%, 15%, 20% or even more. But will this mean that the businesses in which we are investing will evaporate. That is not going to be the question. So if the market falls, then you are going to buy more.
3 years ago, Vetri wrote a piece on Teachers' Day saying that market is my best teacher. Vetri, you illustrated how even in bad markets, stocks made money. Maybe you want to exemplify.
Sure. So, I think it goes back to something that Ramesh said as well, that I think, it boils down to distinguishing between just looking at the market as, sort of aggregate number and everything related to that, and then actually putting that aside and looking at which are the companies to which you want to allocate capital. And these are actually two very different, sort of processes. And I think people need to treat these two separately. You can have difficult markets but good businesses, and the reverse is also true. So I think that distinction is something that people really need to develop, and it's something that I learned the very hard way, because I entered the market in 1994 in my first professional job. The market was like a sprint in the first 6 months of my job. I think it went up 50 or 60%. The index
to 4,464. Yes.
So that was September 94, 6 months into the job, and I felt wonderful about it.
Felt a genius.
Yeah, like a genius. And then 9 years later, which was
1,800.
Yeah, it was 30% lower 9 years later.
Yes.
Right? Now, you could either choose to be extremely troubled about that, or you could have given up and gone home and said, this is absolutely a lousy market, no way you could have made money. But, in the introductory comments, those of you who heard, since we have Prashant here on the panel, right, that's a 20% CAGR over 20 plus years, and a lot of that return was actually earned in that period, which was a difficult 9 years for the market. So all I'm saying is that it's possible. We have fund managers on this panel who've done it before, even during difficult times, being able to compound money if you give your money to the right businesses. So keep that distinction in mind when you invest.
Absolutely. Yes, Prashant Jain certainly was the icon of those days and remains one today. Prashant, what are the mistakes investors should avoid?
I think first is you must get your asset allocation right. 90% of the wealth over a lifetime is created or not created due to asset allocation. As I think Madhu was hinting that we pay too much attention to trying to figure out when to buy or what to buy. So we are worried about, should I invest at 29,000 index or 30,000 or 31,000? After 5 years or 10 years, if the index is 2x or 4x, these movements will become minuscule. So don't focus too much on when to buy. The second question we often ask is what to buy. So we are always focused on trying to find out whether X fund is better or Y fund is better, or this business is better or that business is better. I think these two can create some difference to wealth, but not a big difference. Big difference to wealth will be made by what portion of your 100 rupees you invest in an asset like equities, which have the potential to compound in India between 15 to 20% per annum. And how much you invest in fixed income, which, as I said earlier, has a role but grows at a much slower pace. So if you compound at 15% per annum, 20% per annum over 20-30 years, that wealth can grow many, many times. So the key to ask is, and bulk of your time should go on trying to figure out what is your own individual risk appetite. What is that portion of your wealth which you can spare for 3, 5, 10 year periods, on which you can tolerate 10, 15, 20% temporary downside, both financially and emotionally, and invest the same, either directly if you are conversant with equities, or you can come to a mutual fund and remain reasonably diversified. So I think in India, if you see, we invest more money in gold than we invest in equities. And that is a very big mistake that the entire country has been making. So foreign ownership of Indian equities has gone up from 0% to 24% in last 25 odd years. So who has sold those stocks? Indians have sold that stock, right? And what have we done with the dollars that we get by selling our stock? We have been importing gold. So we have been, without realizing it, reducing exposure to an asset which gives 15-20% per annum and moving into an asset which gives you single-digit returns. So I think the key is asset allocation. You must appreciate the compounding potential of equities, as Madhu, Rameshji, Vetri, everyone has emphasized. And I think the best and the easiest, the most effective thing is to simply get our asset allocation right.
You know, what, as Vetri said, in those years, 1994 to 1997, 27th December, 27th January, that's the day the index went to 1700. I mean, that's a measure of the fall from 4464 in September 1994 to January 1997 when it went to 1700.
In fact, longer. In April of 2003, it was still 2900.
Okay.
So it was actually a 9-year
period.
Winter down 30%. Yeah.
And the point, if I may add to what Vetri is saying of how markets performed during that period, between 93 and 2003, Infosys went up like 1,000 times. Yeah. Right? So many other companies went up, in the
Godrej,
technology
I
space.
thought, Vetri, in your essay. Godrej was one of the stocks that went up during those
a lot of them
bad
went up.
A lot of them, the IT and the consumer companies, all did phenomenally during
Lata, what they do, I've been a part of the index committee, and what they do is typically in a very high crescent, they include that in the index.
Exactly.
So and then when it falls, it kind of distorts how the index is. For most people, stock market should be a bottom-up business, finding a great business and not paying too much attention. Yeah, you got to pay attention to euphoria and pessimism because markets will gyrate, but pay more attention to the underlying business you're owning. Suppose it goes down after you bought it, 20% or 30%. It can happen even tomorrow. Have the courage to buy some more.
Okay. Yep. The part of it is the courage to buy more, but part of it is also to recognize a mistake and come out. Maybe that distinction is not always easy.
Would you repeat that? I didn't catch the entire.
A stock that you bought, perhaps at 1,000, has gone to 600.
Right.
Is it a question of keeping the faith, or is it a question of recognizing that you made a mistake and come out?
It's a tough one, Lata. It's a tough one. That's what you get paid for. That's what you make money. That judgment call you have to make. Is the market wrong or am I wrong? And it does require some self-introspection in that matter. There's no easy answer to that.
Okay. Well, let me come to perhaps an easier question, Ramesh, and definitely easy for you. What is the Infosys of today? The Infosys that beat the market so much in the 90s. Which are the set of stocks? I mean, I wouldn't expect you to even name, but which are those sunrise sector now? Name one.
I've come on your show and said I'm very bullish on cybersecurity. Well, I feel that there will be there are 6 countries with nuclear power, and that could be a problem. Everyone's watching. But cybersecurity can be launched by almost any country. Burundi could launch it. So it's a big area. We all have to protect our intellectual assets, our software, our financial accounting. Big. Of late, I've been very enthused by this movement from unorganized to organized, looking for value and seeing a demand explosion. There's just absolute demand explosion happening, which is actually scary to me. And I think one way to express that is perhaps through the quick service restaurant formats, because I feel it pays right into the demographic trends that I'm looking for. People are going to eat out, people want air conditioning environment, people want value meals, and we now typically in a city like Bombay, for example, eat 8 meals out of 100 meals a month. If that goes to 11 or 12, which is in, say, Indonesia 22, Philippines 26, these guys will just, rake in the money. Valuations are fairly cheap. There are 1 or 2 large players. I would start looking at them.
That's an interesting statistic. I should be eating more, not 8 out of 100 meals, but 22 is the goal to go. Madhu, what would you say? What looks like a turning sector now?
Let me say, Lata, I think the next 10 years are far more going to be very exciting because it's not only period of wealth creation, but I think the way technology is changing, there's going to be enormous amount of wealth destruction also. Because the way, technology is changing so many things. So it's just in a traditional manner to say, I buy these businesses. You have to always look, what can technology do to my business? Let's say, for instance, you're talking about electrical cars. Our power minister made a comment that by 2030, his wish list is, or his vision is, that all cars in India should be electrical vehicles. So what happens to companies which are associated for producing these normal vehicles? If it has happened at 2030 or 35
or 25 or 28. We don't know. But we have to look at technology as a very big element when we are choosing sectors. So that is one very broad new element, as I would say, has come. Yeah, other thing is, I am particularly quite positive, let's say, for instance, in the tourism sector, because with the same analogy, that, the tourism sector market cap is so low today, with 120 crore people, with per capita income actually rising. I'm sure all the people who are sitting here, if you ask majority of them, highest amount of their expenditure will be on travels, tourism, and when you go for holiday. Liquor, for instance, in absolute market cap sense, look at where ITC is and look at where the combined market cap of all liquor stocks are. Look at the size of the business of cigarette and look at size of the business of the entire liquor industry. And when we talk about the ban, it's not so easy to ban things, If 150,000 crore rupees of state revenues which are at stake, if you completely ban a liquor, and nowhere in the world has that ban worked in that fashion. Can you ban it? Yes, you can. But what I hear about Bihar, where the liquor is being banned, is not something which is worked as the government also would have thought it will work. So there are a lot of these smaller sectors, apart from obviously affordable housing. Anything to do with whether you are part of affordable housing in terms of what you are doing to build those houses, or you are in the financing area. I think that sector again looks quite promising.
Unfortunately, everybody is bullish on affordable housing, but one affordable housing guy I spoke to was the least bullish.
That always happens, when promoters get bullish, it's time to be scared.
Okay. Well, Prashant, in the same vein, technology. About 10 years ago, I thought telecom, everything seemed to be happening on the mobile. And the observation only turned out to be more and more correct. I never thought that I would call a taxi on the mobile. I would watch television on the mobile. Life is only, whether you're entertaining yourself, whether you're traveling, whether you're keeping in touch with your family, just about everything is happening on the mobile. But it's not yielding stock market returns. Is that a place to be?
So I don't know, I am slightly confused about the telecom sector, but I think we should differentiate between growing industries and which can create wealth. So Mr. Buffett has said on a number of occasions, for example, the car industry, if you see in the US, it grew phenomenally, but it did not create wealth. So I think we have to find businesses which have some competitive advantages and they can deliver on reasonable returns on capital employed. So I think growth need not always equate with wealth creation.
Let's see your tip on how would you identify good businesses, great businesses. At the moment, where are the turning themes?
So let me just give you a different perspective on that. I think, both Ramesh and Madhu have touched on some emerging areas. But, the other day I was meeting with a consumer goods company CEO and we got into this debate about this whole, cutting off cord and people are not consuming mass media anymore. So how will you build your brands? How will you get through to the millennials? And he said, this is a good conversation for you and me at this table, but there are about 250 million people in India who are still not even my consumers. And they are dealing with a challenge where the only way we can get through to them is we give them a number. They call that mobile number, we play them a few Hindi songs and we throw in a few ads as well. Right? So I think India is a country which is sort of living in its past, present and future simultaneously. And we shouldn't lose sight of the business that just because a lot of this stuff which is future sounds very exciting, it's very interesting, there's scope to make money even in the old boring stuff because this is a country which is, as I said, past, present and future all at the same time. And again, when you just look at things like growth, I was seeing this very interesting piece of statistic, tobacco, right? Altria, the old Philip Morris, is one of the best performing consumer stocks in the last 15 years, despite tobacco consumption going down every single year, right? So
last 50 years actually, since World War II.
Yeah.
It's been the best performance.
Yeah, in the US it's been going down 15. So, and it's still a great performing stock. So it's not so simple as saying that just because something grows, you will make money. And as exciting and as sexy as technology sounds, there's a lot of money sometimes to be made in the boring stuff. So Yeah, keep
So
that in
is
mind.
it time for boring stocks? Steel, ICICI, SBI, the smokestack stocks, so to speak?
I think the differentiating factor there, Lata, has to be companies which have some degree of pricing power. To my mind, over many years of experience, that has been the distribution factor between companies that manage to survive and those that don't. If you don't have pricing power, if you're in a commoditized business, then eventually the tides of time get to you.
Okay. Well, now for an awkward question to the fund managers. How do you choose the best fund, Prashant? Type HDFC.
You could do that, but you could also read a book, Common Sense on Mutual Funds by John C. Bogle, and read the first 3 chapters. I think it will be very insightful for you.
Okay. Now, there are myriad funds. So does one look at 1 year, 3 year, 5 years, 7 years? What kind of a run rate would give you confidence in a fund?
See, why do people come to active funds? You come to active funds so that they do better than the index. So I think, to my mind, the best measure of how good an active fund is just look at the consistency of outperformance. So you could look at discrete years. So let's say last 10 years, last 15 years, last 5 years. Just write the returns of the index every single year, write the returns of the fund every single year, and look at the consistency of outperformance. And funds that have outperformed the index more consistently, I think are better funds than the others which have less consistently done so.
Petri, your recipe for choosing a fund, we have discussed a lot about how to choose a stock, how to choose a fund.
Well, I'm handicapped on that because I stick to picking stocks, so I'll let Karvy do the bit about helping all of you select your funds. That's not my territory, thankfully.
Well, there are 2 gentlemen here who are not fund managers, at least not actively fund manager. He's advising, of course, Reliance Mutual Fund. But Ramesh, if you have to advise people on that front.
Of course, I do my own investing,
Exactly.
you know that. But what Buffett has said, I'll repeat what the guru says about investing in mutual funds, which he says, for most people, buy a simple fund that tracks the index with the lowest cost. You remember, every time you pay brokerage or a load, it reduces from your return. You can't make more return than the market. So you're giving away 2% or some brokerage every time a stock is churned. You're giving away a lot. Remember, a small amount of agent compounding will make you wealthy. Otherwise, you have to go by the fund manager you trust. I think there are clearly fund managers like Prashant, who's had an absolutely stellar record, Madhu, who's had so many 100-baggers. So you have to go by your belief in that fund manager. And the important thing to track is just not how they've done in the bull market, because a lot of people in the go-go bull markets will do well, but how the stocks fared in the bearish period. So you want to look someone with a track record, how he did in the bearish market, how he did in a bullish market. That helps investors.
Okay. Well, Madhu, let's have one round of you telling us about one interesting stock experience that you lived with and were happy about.
I
You
hope,
don't have to choose one, you can choose more.
No, I think we have had many stories which have done exceedingly well, which is part of India. But one stock which is down today, but I am particularly proud to be associated with is Divi's Laboratories. It is a company which is from Hyderabad. It's a impeccable and extremely competent management. We could buy it at the right time, and we have been invested, over a period of last 10, 12 years. They have had some regulatory challenges, but this is what it is, that do you have a faith in the management that they will overcome it, and they have not committed a blunder which is irreversible.
Actually, if Anuj were with me, he would have said, Madhu, there is one stock that you enjoyed investing in and it should not be Divi's.
Yeah, but, we see, Lata, we bought, when I was 2002-03, I'll tell you how I bought Siemens. I bought Siemens when the absolute market cap of Siemens was 250 crores.
Oh.
Absolute market cap.
Wow.
And somewhere I read that, Siemens in Germany is billions of dollars, Siemens in China is billions of dollars. And I thought, how can it be in India for 250 crores? And at that time, and then you saw what happened to Siemens. So we have had many stocks in our portfolio, whether it was Jindal Steel and Power, whether it was Siemens, whether it was DVs, whether it was Torrent Power. So there have been many, many such ideas from time to time. Pharma sector as a whole, we had a significant bet. So just give you an analogy what Rameshji was telling. In 2008, when we actually aggressively invested in pharma sector, DLF was equivalent to twice the market cap of the entire pharmaceutical sector. In 2016, Sun Pharma was equal to twice the enterprise value of the entire real estate sector. So this is how much life changes.
Time to buy real estate?
I think so.
Stocks?
I think so.
Okay. Well, Prashant,
let me tell you again, real estate stocks, I was just running it, the number. The absolute market cap of all real estate companies put together is less than 1% of the overall market cap. Oh. And I tried to search any other country where this exists.
So abysmal.
Is it 1%? But can you, when you're talking about real estate sector, can you go and buy just any real estate company? The answer is no. So that is where the fund managers, the experience, the ability to identify who you can trust, who you can't trust comes in. But as a sector, I think it offers the opportunity.
Prashant, an interesting story that you want to tell us about a stock that you lived with or you're sorry about.
So when I look back actually at the last 23, 24 years that I have managed money, it did not happen this way, but when I look back, I realize that while we have been a bottom-up stock picker, there are three broad themes that we caught right. So in 95, without completely understanding what the future was, we bought IT stocks. And as Rameshji said, they went up few hundred times. And by 99, we had the good sense, fortune, or some people say just reckless behavior. We sold IT stocks because we realized that even if these stocks were to grow at very high rates for long periods of time, they were just too expensive. And we also realized that if IT were to grow so fast, then the rupee would appreciate very sharply, which was not good for IT. And we realized that the old economy stocks were trading at half, like Madhu said, Siemens was 250 crores. So we also bought Siemens around the same time. So you could buy the entire old economy at throwaway prices. And some of these companies over the next 7-8 years went up 30, 50, 100 times. A company like BHEL, I remember having seen it go up from 100 rupees to 3,500 rupees. In Jan 2008, the market capitalization of Hindustan Lever was same as Jayaprakash Industries. And that again was a period of excess. And that was the time when we realized that this capex theme, old economy, was probably overvalued, and we picked up companies in pharmaceuticals, FMCG, automobiles, which were extremely cheap.
You bought Hindustan Unilever below 100?
We did not buy Lever, but we bought most other companies other than Levers and ITC because they were far too cheaper. And they have done much better actually, though Lever has also done well. And last 2-3 years, in my opinion, we have been sensing that this whole rush for free cash flows, FMCG pharma has probably got overextended. The economy is changing very materially. We are moving from a high inflation to a low inflation period. We are moving from a period of depreciating currency to one of stable or appreciating currency. We are moving towards lower interest rates. So I think businesses which will do well in the next 3-5 years will be quite different. They are the ones that will benefit from lower interest rates. They are the ones that will benefit from pickup in capital expenditure. And they are probably the ones that will benefit, not get hurt from an appreciating currency. So when I look back, it is these three broad calls that have worked to our advantage.
So what is that, NBFC? I mean, low interest rates, not worried about rupees.
Anyone who has leverage benefits from lower interest rates. Anyone who is cash rich suffers from lower interest rates.
Yes.
Disclaimer that, a lot of us are discussing stocks, individual companies. This is just to illustrate, it's not an invitation to buy these companies.
Well said. On that note, since I've made you all say uncomfortable things, you've taken that disclaimer. It's an hour since our experts have told you about the wisdom of investing in stocks, the dangers and the fruits if you sit through the difficult times. The floor is yours. You can ask your questions. I must make a request which has come from the organizers. They have to be questions. Please do not make comments because we will have time to make comments. Sharp questions, short questions will help. We will accommodate more. Please, sir.
My question is to entire panel, whoever wants to answer. We are discussing today is the mother of bull market there, you know. Whenever in the last 30 years, I've been investing for 40 years, whenever there is a bull market, there is a lot of discussion. And I have a request to Lata in particular, please call these eminent jurists here when the bull market is about to end. That will be of great help to the investors.
You will know that it has ended only after it has ended, sir.
No,
and let me tell you, as Ramesh began when saying, if we are not in a bull market, this hall would not have been full. Halls normally fill in when markets are in a bull grip. This is the nature of human behavior.
I'm just saying that when the things are pessimistic, I think anchors like you, and I've been watching CNBC TV 18 ever since it was born, I think you should call these people. They've got wealth of knowledge. And I've been, met a couple of them personally, not all of them. So that will help. The second thing is that you started your, introduction by giving the new normals, etc. Again, this question I'd like to specifically ask to Ramesh, that how much role does the flow of liquidity overshadow all the normals? Because I find normals are used to justify one way or the other why market went up or why market came down. But I think that the upward trend is driven by liquidity alone, along with some of the things like the growth and etc., fundamentals.
You're right, sir. As has been very famously said, liquidity is the mother's milk of a bull market. So, yes, you need an easing. If interest rates are rising, people are going to go to fixed deposits. So you need easing liquidity. There's no question about it. But at some point, earnings will have to catch up. Otherwise, it becomes a bubble. Like you saw the Tulip bubble, or you saw the South Sea bubble, or you saw the NASDAQ bubble. A lot of liquidity, but at the end of the day, it has to be supported at some point by earnings. But if you say true or false, is liquidity the mother's milk of a bull market? Yes, true.
Absolutely.
It is.
Yeah, just to.
We have to allow, there are so many people here who have their hands up. Prashant, you want to take that? Okay.
Yeah. I think again there is a selective opportunity because this is a sector which has been out of favor for some time. Even though the broad tailwinds are not in favor of this sector, but that doesn't mean the whole sector will not do well. There are selective opportunities, and if you are a long-term investor, maybe this is the right time. I just want to add a comment on what you said. Sir, we have consistently over last 20 years tried to come wherever there is a real crisis, whether through the medium of television or whether through medium of holding this kind of conferences, and try to meet investors. But the unfortunate thing is that this is the only asset class in the world, higher the prices, higher the demand. Lower the prices, lower the demand. When I want to come, when there is a crisis, in the hall there is not even 20% people. Now you tell me what do I do?
No, point taken actually. Prashant was with us on television on the day the index was going towards 5,100, August 27th, 2013 or thereabouts. And if people had listened to him on that day, mouth-watering valuations were his very words. You should keep the faith at that time. You should switch on television at that time. Any further questions? Yes, the gentleman right behind. Please keep the questions brief. Let's get to the back seat first. We shouldn't let the front benchers hog the limelight. really appreciate if the questions are short. We have to accommodate a lot more people.
Sir, I want to know how to get a 20% return so that our asset allocation is the perfect. I mean, I'm not talking about the markets, Nifty, every year 10%, or let's say next year the market was crashed by 15%, minus 15%. How we can allocate the asset, like this much percentage equities, this much percentage bonds, so that minimum, sir got 20% CAGR every year. Here everyone wants to become rich in the markets. So how do we have the perfect asset allocation?
What is the formula for asset allocation?
The perfect, like how much equities and how much bonds or else, so that we'll do good in the bad weather.
See, equities have the potential to deliver between 15 to 20% CAGR, and under Indian tax laws, it is tax-free if you hold it for 1 year. Bonds and fixed deposits will compound at much lower rates. So on your entire wealth to target 20% CAGR is difficult unless you invest 100% of the money in equities, which probably is not the best thing to do for most of us. So 2 questions which you must ask yourself to arrive at the right asset allocation, though it is ideally Karvy's domain, but I will give you my 2 bits on it. Ask yourself 2 questions, that what is that portion of your wealth which you can keep aside, which you don't need for the next 3, 5, 10 years. That is question number 1. Let's say it is X%. The second question you must ask is, what is that portion of your wealth which if it drops 10, 15, 20, sometimes even 30%, it is a temporary drop, but it can drop temporarily. You will be able to sleep peacefully at night. You will not be emotionally too upset. Now that percentage is your risk capital, and that is what you must invest in a diversified portfolio of equities, either directly if you understand equities well, otherwise there are quite a few mutual funds in India which can do the job for you.
Sir, one more question. Recently, REIT was launched in India, Real Estate Investment Trust. Is it good to invest in that?
Yeah, again, I think you can invest whatever portion of fixed assets which you are fixed investment which you are building in, fixed income investment which you are building in. That can be a part of investment, because I am sure that market is opening up and there will be many opportunities in times to come.
Yeah, the first REIT hasn't yet hit us. Maybe you want to give the backbenchers a chance. It's not fair to stick to the first 3 rows.
Hello? Hello?
No, we can't see who's asking.
My name is Alok Agrawal. My question is addressed to all the panelists present over here. Actually, I agree that India is in a bright spot.
Can you please stand up? Okay, yeah, sorry.
Standing up fully. My name is Alok Agrawal. My question is addressed to all the panelists over here. I agree that India is in a bright spot, but the problem the world is facing as of now, all over the world, we are going on printing money endlessly. All the central banks are going on printing trillions and trillions of dollars, or maybe money. But that money, eventually we are going to land up in a credit trap. Maybe now we are just postponing it, but someday or the other, 1 year, 2 years, 5 years down the line, it's a big credit bubble. So don't you think it's a very big risk the world economy is facing? India is in a bright spot, but we are affected externally also.
Vetri, you want to take that?
Yeah, I mean, you're right that they're printing a lot of money, and that's perhaps something that could at some point destabilize the markets, and we're all interconnected, and certainly financial markets are a lot more interconnected than even real markets are. So everything transmits instantaneously. So that risk is omnipresent. I'm not suggesting to you that it isn't there or isn't omnipresent, but I guarantee you there are also another 100 risks that neither I am aware of, neither you are aware of, and those could prove to be even more dangerous. So the point is, these risks always exist. You, I think, have to take a more sensible decision in terms of what your asset allocation profile is, how much you are willing to invest in equities, and at least sleep reasonably well in the night, knowing that at least in India the central bank is not following those policies. So don't lose sleep over just one issue. Actually, what you should lose sleep over are the risks that neither you know about and nor I know about. Because honestly, that is what eventually does the most damage to markets, not that the risks that have been debated ad nauseum.
Can I just answer it in a lighter sense? Sir, if you are worried about that risk, you would have been worried for the last 5 years because the printing we started 5 years back. Now, do we know exactly that that risk is going to materialize today, tomorrow? You yourself said that it may materialize after 5 years. So let's say it does materialize as you are envisaging. Which means, are you effectively saying that you will be out of the market for the next 10 years, which is 5 years of last 5 and next 5 years? It is a very tough thing, you know. When I started investing, one of my friends came and told me the oil prices have gone up from $25 to $40, and it's a big risk for India. So please wait. When the oil price corrects, at that time you should buy. The fact of the matter is the oil price went from $40 to $150, and in that period, a lot of stocks went up 10, 20, 30, 40 times. So I think it is very difficult to isolate and think about one risk factor and be away from the market.
I agree, sir.
We have to move on. Someone else, please.
Thank you.
Yes.
Hi, my name is Vijay Kumar. Just one quick question. If you look at the US market and compare it with the Indian market, the number of companies listed in both markets are roughly the same, but 70% of US GDP is reflected with the companies that are listed there, whereas in India it is only about 4%. Is it a case of too much being put on too few quality stocks in India to reflect as the overall growth that is happening in the economy, and as a consequence, too much money chasing too little, very few stocks that can add real value? Thanks.
You want to take that?
I think your statistics are incorrect. I'm not sure where you get 4% of GDP is listed. It's more like 80-90% of our GDP is... No?
The size of the GDP is $2 trillion, and roughly the size of the market cap is also $2 trillion. So there is some disconnect in the number which you are saying.
Sorry, I'm not mentioning about market cap. You're right about the market cap. If you just look at the revenues or the market cap and contribution to GDP are two different things. If you look at the revenue of the 4% of the companies listed in the market, they are adding just 4% to the GDP, while the market valuation is what it is.
That is incorrect. See, if you just look at the software sector, it is $100 billion revenue roughly. That itself is, 5% of India's GDP. So I don't think somewhere your numbers, to my mind, are not adding up.
I cannot readily say what will be the total revenues of India's listed companies, but it does look like 4% is an understatement. Okay, yes?
Hassan Panigrahi. GST implementation is a few months away. What could be the impact on equity market? One, given the fact that whenever GST is implemented world over, there is inflationary effect is there. Recently being experienced in Malaysia when they implemented in 2015. And what could be the Indian scenario few months away?
Who wants to take it? You want to take it? Vetri?
Yeah, sure. So, I think there's been a lot of literature about GST and what will happen, and we've got the experience, as you said, of what's happened in Malaysia. I think every country is a sort of different kind of outcome as to what has happened. Certainly there is likely to be some short-term disruption. I would take with a pinch of salt some of the statistics which have been thrown around saying that GDP will immediately increase by 100 basis points or 150 basis points. But I think over the longer term there is clearly a net positive impact on the economy of GST. More companies moving into the formalized sector, employees getting the benefit of companies moving into the formalized sector. You'll also get the benefit hopefully of a higher tax revenue base for the government, better fiscal for the government, and eventually all of this should make Indian companies more productive, which should be a contributor to higher GDP growth. So I think GST per se over the longer term, unambiguous positive, but over the next, I would say 6 to 12 months post GST, ignore a lot of the statistics, they are going to be all over the place.
Statistics in India is anyway all over the place. Yeah. GDP statistics especially.
You don't even need GST to have GDP statistics all over the place.
To go all over the place, absolutely. But I just want to add that the extent of sensitivity to inflation I have seen in political circles, secretaries, politicians, to the impact on inflation, it is so high that my sense is that that one trap may be avoided. They may not be able to avoid the extent of slowdown in output because people don't know what forms have to be filled, how do you step into the formal economy, what will be the stocks I will be left with on the day GST starts, and therefore let me stop producing 1 month earlier, 2 months earlier. There could be a bunch of factors which may slow down output for a quarter or two, but my sense is inflation is not going to be impacted because the sensitivity that I see in Delhi is very high to the inflation impact.
Lata, if I may just add, an equity investor does not have to worry about inflation. That's the fundamental reason why you must invest in equities, because equities create real wealth equal to the real growth in the economy. And inflation is a pass-through for businesses. If there is high inflation, it means companies' turnovers will grow that much faster. So I don't think if you are investing in equities, you need to worry about moderately high levels of inflation.
Okay, well, I think we should be winding up. We have been up for an hour and a half. Maybe we give 2 questions. Yes, please. I'm sorry.
Good evening, all.
Yes. So, yeah, there. Can we get a mic to the front row, please?
I have a question too.
Sorry. Oh, why don't you do that?
I have 2 questions. One to Mr. Damani. I mean, last few months I've been thinking some of the stocks are very, very expensive. You take RBL Bank or D-Mart, the issues have come at 40, 50 multiple, and over and above they have become 100, P multiple of 100. I mean, there's a kind of a little discomfort, but you made it very clear. You see the opportunity. Can you amplify that so that we understand that better and then, we become smarter? The other question I have is, how do you look at the PMS funds? I mean, is the PMS is a better alternative if you are not able to do on your own, and maybe PMS can deliver better returns over the mutual funds? I want to thank Karvy for bringing the best market brains here. Thanks so much.
Thank you, sir. Look, I think I use a lot of examples of Buffett because he explains everything so clearly. It's like you're playing a game of cricket and, suppose you're playing an IPL game, you have to swing at every ball. Okay, every stock you have to have an opinion on. But what Buffett says is that you stand by and wait till the ball is a full toss or, low pitched ball which you can hit out for a 6. So you don't have to buy every investment stock that is there or you're uncomfortable because they're so expensive. But occasionally a good, nice, juicy full toss lands in front of you and you can hit it out of the park for a 6. And the point I'm saying is that even in India of 2017, there are enough softballs landing in our bat that if we are cognizant of value, you can hit it out of the park. It's not too late to find those bargains. The bull market is only 3 years. It might last 5 years, 7 years. I don't know. The US market, bull market has lasted 11 years this time. So who knows? But we will know. I mean, there's very clear signs emerge when bull markets stop out. So I think look for the soft ball coming towards you that you can hit out for a 6. Don't buy the expensive stocks if you're not comfortable with. Investment is an article of faith. You have to believe that you're buying the business and you want to hold the business for a long period of time. So don't get carried away by momentum. If you feel that this is sillily priced, step away. Don't take that ball.
Okay. There was one more.
Yes. I have a question.
Yes, please.
Yeah. Good evening. I wanted to ask you that you mentioned the secret of wealth creation. So I wanted to understand, how do you pick a company or a script which creates wealth? Because there was a point that a tobacco company who's been, where the consumption has been going down over the years, but still has made so much of wealth. So what is the secret of picking a company or a script which creates wealth?
I think each one of you can give one feature at least. It's a great question to answer.
It's a great question, of course, ma'am. But I'll tell you simply, and it's a bit simplistic, but you need to think of what I'm saying. Buffett gives us a concept called circle of competence. Invest in what you know. So, for example, if you are a doctor, all right, you may not know a lot about steel or software, but you know a lot about pharmaceutical companies. Who's got a cure for diabetes going on? Who has the new cancer drugs available? Who's making good generics? So maybe you should invest in pharmaceutical companies. Now, what is your profession? Are you a housewife or do you do some...
I'm an entrepreneur.
You're an entrepreneur.
Yes.
So maybe you can look at, the venture capital, startup areas that are coming out there. Housewives ask me this question quite often. And I tell them that maybe you don't know much about software, but you know a lot about which consumer goods offer value. Is Lever better? Is Titan better? Is, Dabur better? Is Patanjali better? So try and invest in the circle. You know what? Nobody knows 5,000 stocks, not even people on the panel here. We tend to restrict our expertise to some areas. Madhu may be very good in engineering stocks. Prashant is great in public sector stocks. So we tend to find a circle of 50 or 100 stocks and watch them very intensively.
Your formula, Vetri.
Sure. So, in my experience, the 2-3 sort of criterion that you want to gain an understanding of, and it's not necessary that all of them point in the same direction. So while we talked about Altria, I think it certainly helps to have companies where there appears to be a significant runway in terms of growth potential for that business. Secondly, it needs to preferably be the kind of company where it's cut cloth to measure, so their growth that they are getting is in line with their ability to finance themselves, and they're already earning a reasonably healthy return on capital. So it's like the difference between a plant which requires a lot of water to be given multiple times or one that requires water to be given only once or twice. So typically I have found that you get the better results from companies that don't require too much water to be constantly fed to them. So if you typically have a long growth runway, not too much capital requirement, then I think typically that tends to combine together to give you very strong and powerful outcomes.
Frankly, I will leave it to Vetri and Prashant and Madhu to find stock. Difficult for me to do that much. But Prashant, what would be the magic?
So I think, I would like to give you a different answer. And see, investing appears to be very simple, but it is not easy. And so simple things in life are not easy always, and investing is like that. So whenever you need expert advice, you go to an expert. If you are ill, you go to a doctor, and so on and so forth. So I think whatever you and I do for many years, we become better at that. So I would suggest that unless you are good at this, you would probably better off leaving it to expert managers. And I have seen in last 3 cycles, in every cycle, 90% of the investors, just my gut feel, they lose money. They don't make money. So when did people buy IT stocks? They did not buy IT stocks in 95. They bought bulk of them in 99, looking at the past returns. In 2008, no one was buying consumer stocks. People were buying infra stocks and capex stocks. Last 2 years, people were buying FMCG stocks and pharmaceutical stocks. So there is a tendency amongst most of us to simply extrapolate the past into the future. I don't think that is always a good approach. So I would suggest that unless you are really good at it, you have experience at it, you should better off leave it with the professionals. And in India, I think we are in a good situation. Mutual funds are extremely well regulated, very transparent, very easy to deal with, and there are a number of funds which have phenomenal track records. There are many funds in India which have beaten the markets between 5 to 10% CAGR over 5, 10, 15, 20, 25 years. So I think you do what you are good at and let people like me also keep a job. Thank you.
Also, I would just like to add one thing that, what Rameshji started with. The stock market is a place where people with experience meet with people with money. People with money get the experience, and people with experience get the money. So I would say that, you don't get the experience at the cost of losing money.
Fair point. I think that was a great way to end this fruitful 1.5 hours of discussion that we have heard from some of the veteran fund managers in the country. The formula that each of them is using is different, but they've all been extremely successful in the art of making money. I would trust them, but I leave it to you to decide whom you trust. Thank you very much. And thank you, Karvy, as well.
Thank you very much. Please stay back, Lata ma'am and all the panelists. please allow us this moment to felicitate you all. I'm going to invite on stage Mrs. Shabna Iyer from Karvy, requesting her to felicitate our panelists. Ladies and gentlemen, you've been a wonderful audience. Please stay back for 2 more minutes. We would appreciate if you're witness to this ceremony of felicitating our panelists. Mr. Ramesh Damani, thank you once again, sir. Mr. Vetri Subramaniam. A huge round of applause for them, ladies and gentlemen. Ms. Lata Venkatesh for moderating the session so well.
Thank you.
Mr. Madhusudan Kela. I'm sorry. Mr. Prashant Jain. Thank you so much. I'm sure Hyderabad is super delighted. It was such an invigorating session. We all have a lot of points to take away. With that, ladies and gentlemen, I'm going to invite on stage Mr. Rajiv Ranjan, Head Equity, to propose the vote of thanks.
Good evening, ladies and gentlemen. This has been truly an outstanding and scintillating evening for all of us here. We got huge sorts of knowledge and deep insights from our illustrious panelists. With their credentials, all of us knew well in advance that it will be an extraordinary session from the word go. But they have surpassed all our expectations. Like Sensex, they have hit an all-time high. Mr. Ramesh Damani has so nicely articulated his views on the feature of bull market, that each bull market is always stronger than the previous one. And the current bull market proves that. Mr. Madhusudan Kela had so nicely expressed his views on 6 trillion GDP in 10 years, and we hope that we achieve that. And that will ensure that the bull run continues at least till 10 years. As long as it's backed up by transparency, we need not fear about minor macroeconomic setbacks. Mr. Prashant Jain was spot on when he said about get your asset allocation right and don't try to time the market, don't ask when to buy. Mr. Vetri Subramaniam was, as usual, at his sparkling best when he touched upon the topic that it's with the boring stocks that you get to make more money. So don't always chase exotic stocks. We sincerely thank Ms. Lata Venkatesh for her well-versed freewheeling moderation of these top-class panelists. I really loved when she said that I hope we have got T-shirts printed with 1 lakh Sensex. Yes, ma'am. We came out with the report 2 years back that Sensex is going to hit 1 lakh. T-shirt, yes, we are getting printed. India is truly in a blessed position with several micro and macroeconomic factors working in its favor. The demographic dividend, where youngest population we have highest in the world, the growing trend of assets moving from physical assets to financial assets, and among financial assets to moving from fixed deposit and bonds to equities, that tells us that the habit of investing through both directly, that is through a stockbroker, and indirectly through mutual fund is gaining ground, and that's what is going to fuel a very long run of bull run in India. We have been tracking 26 indices, and you'll be surprised that all the 26 indices have given return in green in the year 2017, year till date. Now, what more proof you need that we have a mother of bull runs? We sincerely thank the overwhelming response from our clients, well-wishers, stakeholders, and audience for their unconditional support, immense patience, and rapt attention throughout this event in making it memorable. We sincerely hope all of you enjoyed the event as much as we have loved in putting it together. Looking at your outstanding response and the scale of this event, we feel this is not just mother of all bull runs, this is actually grandmother of all bull runs. We at Karvy congratulate all those who are participating in this feast of Indian wealth creation and invite those who are waiting to join this party. Thank you. Jai Hind.
Thank you very much, Mr. Rajiv Ranjan Singh. Thank you once again to our panelists and Lata ma'am. Ladies and gentlemen, that marks the end of today's event. It's been a delight for us to host you, and we look forward to have you all for the next Finapolis Knowledge series. Please join us for cocktails. It's being served in the pre-function area. The dinner is being served in the level down. It's one level down than this. And please do not forget to pick up your information kit outside the dinner area. I repeat, please do not forget to pick up your information kit at the counter outside the food area. Have a great night, ladies and gentlemen. Do remember to drive home safe. Thank you.